Welcome to This is Wealth. On this podcast, we ask, what is wealth? What does wealthy really mean to you? Most of us immediately think of money, but honestly, wealth is so much more than that. If you have health, deep friendships, a supportive family, you have great wealth. My name is Liz Crawford. Get ready to be impacted. In today's episode, Joe Gonzalez, founder and CEO of Lending Strategy Advisors, joins us to share what you need to know about lending. Many of us assume our best option is to call our favorite banker, share our future plans, and get started on paperwork. Joe is going to walk us through why that may not be our best option. He's going to demystify the lending process and help us to think one step ahead of what we are trying to accomplish when borrowing money. Get your pen and paper out and get ready to learn with me. Joe, thank you for joining me today. Tell our audience a little bit about you and your background, because I think this is a very unique experience you have.
Well, number one, thank you for inviting me. I think that, the idea of borrowing money for a lot of clients is the great unknown. So hopefully today we'll be able to help clients understand what happens when you decide to borrow money. But as far as my experience, I spent the better part of 40 years in banking and particularly consumer lending. I loved what I did. I loved being able to sit down in front of clients and help them figure out how to borrow money, how long they wanted to borrow it for, etc. And so, I started in banking when people didn't even have FICO scores. I mean, seriously, you just kind of sat there and said, and to get a credit report took a week.
Yeah.
And so then you got the credit report and you would look at it and you'd sit down with the client and go, look, so what happened here at Sears? You actually had to sit down and talk to people face to face.
I remember that. It was a little bit like an interview.
It was a lot like an interview, especially when you hadn't made a payment or two at Sears or JCPenney.
Right.
But anyway, basically, the industry evolved and there were certain catalysts to big changes in that industry that I kept thinking, this is not necessarily heading towards a more consumer-friendly environment. But ultimately, I retired in 2019 from mortgage lending, from banking, and I started this consulting firm, Lending Strategy Advisors. And I took basically, 40 years of experience. I call it the decoder ring.
Right.
And decided that I was going to, climb over the wall, if you will, from the bank's perspective and sit on the consumer side somewhat with some ammunition, somewhat with I know how these things work. And it inspired me to do the work and form the consulting company.
Well, I remember when you and I sat down to talk about this idea of forming this company, and you asked if I thought it was feasible to create a business around this. And I thought, oh my goodness. I mean, truly, somebody to guide clients through the process of, okay, why are they asking for this information? What are they going to do with it? I mean, we have all seen banks go from what you first described as let's interview and see how this is going to, let's get as much data as we can and see what we can do with it,
right.
Which you allude to is not necessarily in the consumer's best interest.
No. I'll tell you, I think that for the most part, we're all sort of Boy Scouts. We want to tell everything to everybody, right? But the reality of it is that there is very specific information that needs to be provided to a bank today when you go out to borrow. And then, I think the other part of it, which is that emotional feeling that you have about borrowing, right? I mean, since the beginning of time, borrowing's been designed to sort of give you this hat in hand feeling and I don't care how wealthy you are, because I've dealt with some really wealthy clients and I can tell you they get just as anxious.
Right.
In fact, even more so, because they usually are much more complex, right? But that feeling of am I going to get this? It's there, right? And unfortunately, really a lot of this changed, I think, for the consumer back in 2009, 2010, after what we call the great, real estate crash, right?
We call it the great financial crisis.
It was actually. And I think it was a crisis for the consumer as well.
Absolutely.
I think that the idea that, and this isn't about bashing banks. We need them. We need that liquidity to be able to provide home ownership in this country, as an example, on the residential side. But the reality of it is that the ability for the bank to provide that consumer-centric advisory path strategy, it's just not there. And unfortunately, kind of a window into years from now, I think it's going to get worse. I really do.
I want to talk about that in a minute. Help our audience understand what makes LSA different from a bank.
Sure. I think there's always been the traditional roadmap to borrowing. You called your bank. You called your bank. You just went in and said, I think I need a mortgage, or I want to buy a house, or what have you, right? There are some intermediaries that were created back in the 80s, mortgage brokers, which would basically provide that service of lending you money, but they weren't really the ultimate source. They were providing it through a conduit, a correspondent, if you will. I thought, well, when a customer wants to borrow money, where does he go to get advice? Where does he go to create strategy? Where does he go to create the path for that? And the traditional way was to go see your banker, or you saw a mortgage broker, or you called your attorney or your CPA usually. And most of the time you just got this sort of, well, call your bank, call your broker, right? So there was nowhere to sort of, there was nowhere for you to create that hub, that information hub, right? And so I thought, why can't a client get that? And after 2010, when we saw regulatory changes in the industry embed themselves into banking with Dodd-Frank and CFPB, the government basically started telling bankers, you can't tell them that. You can't guide them there. You can't instruct them to do things. And so for me, it was like, well, that's very cumbersome for a client because they don't understand the guidelines. They don't understand the roadmap. And so I thought, where can someone go? And I started doing the research, and I started talking to very smart people like yourself and asking them, is this a thing? Do you think that there's a need for this service, and not one that is driven by financial payouts from banks? Because even in the broker world, the broker gets paid by the bank.
Right.
The loan officer gets paid by his bank. I wanted to represent the client's strategy without getting compensation from a bank, because I felt that it needed to be impartial. It needed to be somewhat of a vacuum.
You want to sit on the same side of the table as the client, not across from them.
Our goal was to create a sense of you have a team.
Right. We're
building a team around you, the consumer. And to serve as their advocate, really, to me, it was really about advocacy. I felt that the client needed to have that roadmap, needed to have that decoder ring, and he needed to have representation, not just for what you provide, but what you don't necessarily have to provide.
That's, you and I have talked many times over the years, and it's amazing that you can disrupt the lending process by saying too much. Yeah. So we'll talk about that in a minute.
Sure.
And maybe that goes into this next question. What do people need to know that they don't?
Well, I mean, really, borrowing in and of itself, like I said, is kind of this black box for clients.
Right.
They just think, I need a loan, right? But I think helping the client understand, well, what type of loan do you need? You hear what clients can Google, right? They Google their strategy, I went on Google and I looked up how to borrow, right? But the truth is that, you need to identify, number one, the type of product you want to borrow on, the type of occupancy you're trying to borrow. Occupancy is a really big item, a really big detail. And I'll give you a quick example of that. If you're buying a home because you want a vacation in Aspen or Seaside, Florida or whatever, and you and a family want to go in together and buy it, right? But you also are going to lease that out while you're not there. You can create some rental income for you. Well, if you start off with that conversation with the bank, they'll immediately try to classify that loan as an investment property, non-owner occupied. You're not occupying property, which means it's a higher down payment, higher interest rate, higher risk for the lender. But the reality of it is that it truly is a second home. If you can occupy it at least 14 days out of the year, it's not owner occupied property.
Right.
And so just understanding the nuances between what you call the property's occupancy can trip you up.
Right. Right.
Self-employment income, after COVID, everybody started doing gig work, right? It seemed like. And so everybody's got this side hustle that they can get involved in, Etsy and things of that nature. Well, that's self-employed income. And so when you're applying for a mortgage, you may be employed with Sendero or whoever, but you also have the side hustle, as I call it. And that could be a problem because, banks are going to look at that stuff and say, wait, you're self-employed. What kind of liability does it create?
Right, right.
So you have to be just really careful about what that level of detail is that you're going to provide a bank. And they have ways of knowing all sorts of things about you, whether you like it or not nowadays.
It's all connected.
It's all connected.
And it's all available.
Yeah, the old days, it's like clients used to have come in with a big box of papers, like their pay stubs, their bank statements, their tax returns. Today, with automation, especially artificial intelligence in the system, you apply and their systems with these banks will allow those banks to be able to retrieve your tax returns.
Wow.
To retrieve your pay stubs from EDP, ADP, and all those other, to retrieve your credit history, right? And that's not enough. Then they start digging in it. And so they go, well, what's that? And what's that? And what's that? And what's that?
All with that little signature we do.
Yep. Authorization.
Wow.
Yep. And, again, all of that kind of came from that 2010, 2011 change where, lending had become real loose prior to that. And then with the housing bubble, the government sort of fixated itself like, what went wrong and how do we change it? And so
then they overcorrect.
They really overcorrected.
Yeah.
And there is a term that came out of that I think is important for customers to understand, because fundamentally borrowing money really has two principles, and they've been there since the beginning of time. One of them is willingness, and the other one is ability to service debt. And so you have to demonstrate those two things now. It's called ability to repay, ATR. And a lender must follow their little checklist of things so that they can say to, the regulators, like, we did this, we were able to prove ATR. But willingness and ability are demonstrated by how do you make your bills? How do you pay your payments, right? And where's the income to provide that? How do you service the debt? How do you service it within a specific guideline or ratios? But a lot of that is automated today.
Yeah. So you've talked a lot about how the industry has changed over the last 15 years, which really created the need for a company like LSA to help steer people and to have a space. The way I think about it is it's a space to really strategize. Okay, this is what we want to do. These are some options that we may take advantage of if they present themselves. This is what I'm going to use as collateral. This is my story I'm going to tell. And you say, okay, wait, let me ask you some questions about this, help them clarify. I mean, it is truly a strategy session on how best to represent the client so that they look attractive to the bank, which, as you mentioned, has a process that they must follow because it's driven by the regulators. And at any point in time, the regulators can say, hold on, you've got too much real estate in your loan portfolio. Right. So, let's put an end to borrowing there. And if that's your bank and your banker comes back and says, hey, I'm really sorry, we would have done this last year, but this year we can't.
Right.
Then the client doesn't know what to do. Right. So again, this is where I think having your skill set is so advantageous for clients because they've got time to prepare, to think about this, to really hash out with you what they're trying to do, and you've got 40 years of experience to help them think through it.
I agree.
Well, so what happens when, I mean, I think we're seeing this now, is banks are changing the lending that they would have done a year or two ago versus what they'll do now.
Yeah.
What happens?
Well, first of all, to the point of why we exist and why I think we are a thing, and you'll see probably more of us in the future, whether it's growth with LSA or others that decide like, hey, that's a smart thing to do. Let's go help the consumer, right? One of the words you use is steering. Like, that's a bad word in banking. Steering is not a good word, but creating the strategy, developing the strategy, that's legitimate. And to me, when you can create that strategy for the client, you give them the roadmap, you hold their hand, and you see their shoulders relax,
right.
You build confidence. And for me, the more confident the borrower is, the more he's able to execute and make the right decisions. I always tell my clients, like, when you're stressed out is probably the worst time to make a decision.
Agreed. We're working from fear.
Yep. And anxiety, because it's an unknown. Right. You don't know it. But when you hire a company like us, we bring that knowledge base. I'm not the smartest guy in the world. I tell clients this, but 40 years of doing something, usually they say if you spend 10,000 hours in a subject, you become a subject matter expert. So I think that's where myself and others like myself in the industry can assist clients creating that strategy, that roadmap. As to the question about like how banks are changing how they borrow, I think it's important to understand, particularly in residential lending, that when you borrow money today, you're basically borrowing in, and I'm just going to use conventional financing, in what we call agency money, which is Fannie Mae, Freddie Mac guidelines. So when people say, you go to a bank and they say, well, you don't meet the guidelines. It's like, what's the guidelines?
Yeah, where's this document? How do I get one?
Who created the guidelines? Well, Fannie Mae and Freddie Mac create the guidelines. So when somebody says, well, I'm just going to go to my favorite bank, ABC, Chase, Wells, whoever, no matter where you go, the guidelines will prevail.
Right.
Relatively speaking, because at some point, there is a level of decision making that happens when you reach the underwriter, like the underwriter said.
That secret room where they all sit.
Yeah, where they all sit, right? And they conspire on how not to do your loan. But when it reaches that final level of underwriting, that underwriting still happens to a certain extent at a manual level. It's a lot of box checking, but it also is kind of, it's the opportunity for the story to shine and the underwriter, the decision to be made that this works, right? But for the most part, it doesn't really matter if you go to Chase or B of A or Wells Fargo or whoever, because those loans are being sold using Fannie Mae, Freddie Mac guidelines. And a Fannie Mae loan here is a Fannie Mae loan across the street, right?
So talk a little bit about that more. They're being sold. What does that mean?
Well, it means that, when the agencies, Fannie Mae and Freddie Mac, were created like 1938, 1970, it was to provide this liquidity in the market for financing to be readily available, whatever that means in those time periods, right? But
we'll think about those time periods. You had a huge stock market crash people were trying to recover from in the 30s, and then you had the inflation of the 70s and oil embargoes and all kinds of things. So creating liquidity was a way to get the economies growing.
Yeah, and ironically enough, like the first mortgages were not made by banks or savings and loans, which don't even exist anymore. They were made by life insurance companies, right? Or by insurance companies. But bottom line is that at some point we recognized as a country that home ownership was important to us, and we wanted to create liquidity in order for folks to be able to go out and borrow and have an ample supply of liquidity to fund these loans, right? So when a bank makes a loan, they may service the loan. This is where it gets a little tricky, because people say, well, my bank, Wells Fargo, or my bank, I'm not picking on the big guys, but everybody recognizes them. But honestly, there's a really good chance that Wells Fargo, Bank of America, Chase doesn't own your loan.
Right.
They own the servicing rights. They're going to send you your escrow statements. They're going to collect your payments, but they can't really do anything about your loan because it's been sold into a pool of mortgages that are usually Fannie Mae, Freddie Mac mortgage secured. The bottom line is that regardless of whether you go to one lender or another, the guidelines are going to be pretty much the guidelines. Now, where it gets fun, and this is where kind of, our world kind of plays into, which is when we start dealing with high net worth individuals that are borrowing in excess of Fannie Mae, Freddie Mac limits. So what most clients refer to as, mortgages and limits, they're really talking about jumbo loans or not jumbo. And for some reason, I don't...
Explain jumbo and non-jumbo.
Yeah. So for some reason, somewhere along the way, people got deathly afraid of jumbo loans. Like, oh my God, they're so expensive. Well, when I started in the business almost 40 years ago, a jumbo loan limit was $88,000.
Wow.
You can't even buy a car nowadays. I think,
right.
for that much. But anyway, every year, Fannie Mae and Freddie Mac collectively issue guidance on what a loan limit is for a bank to be able to make a loan to a customer, still sell it to Fannie and Freddie. And for the most part, and I'm going to take out high cost living areas, for the most part, that is set in November. Right now, that loan limit is $766,550.
Okay.
So if your loan amount is below that, you're a conforming loan. You're a conforming or agency loan. And agency is important. If you're above that, you're in what the world that most people would call jumbo financing. And jumbo financing, I prefer to call it non-agency because it's not being sold to Fannie and Freddie.
Right.
Now, that's where it gets fun because non-agency money is really a portfolio underwriting or guideline process. So Bank of America, Chase, Wells, the big guys, these guys create guidelines. They follow or mirror basic, agency guidelines, like 2 years worth of tax returns, 2 months worth of bank statements, 1 month worth of pay stubs.
There's a process to it.
Yeah. But that's where things can really deviate, and sometimes in a fun, positive way, because you can do things that you can't do under Fannie Mae and Freddie Mac guidelines. So the idea of being concerned about a jumbo credit loan, I think we need to demystify that because oftentimes it's so much easier, really, because the guidelines are more flexible. Now, the downside is that the down payment requirements, because there's no mortgage insurance in the non-conforming or non-agency world, jumbo world, they limit or they restrict the loan amounts to usually 80%. So you got to come up with 20% down. There's some creative ways to get around that, but for the most part, you need to look at 20% down. But I'll tell you, that's where it gets fun for some of our high net worth individuals and complex borrowers, because you can use different types of income that you can't use in traditional agency, phantom income, dividend.
Yep. Unpack that. Let's talk about that a little bit. So what if you're an executive that has restricted stock? Can that be used?
Perfect. It depends on the lender.
Okay.
It depends on the lender. In the Fannie Mae, Freddie Mac world, there's very specific ways to use that kind of income. With executives, that's a really big part of their comp.
Right.
But you can defer that income. And sometimes it's phantom because it's reported, but they don't get it.
That's right.
And so that's where it gets difficult for a client to understand, like, why don't they count that?
Right.
Why can't I use that income?
Because they can't access it.
Because they can't access it. Correct.
Right.
On the non-conforming or non-agency or jumbo, since that's the word most people use, that's where you can get creative. You can really talk an underwriter through, look, for the last 2 years, he's received over $1 million worth of restricted stock. And technically, it is his to access at some point, right? So maybe we don't give him 100% credit, but maybe we give him some credit. or we use it as a compensating factor.
Mm-hmm.
Compensating factors are important. But as smart as you may be as an executive, you can get really tripped up because you don't understand those guidelines.
Well, I think as you and I, again, have talked over the years, you just may say the wrong thing that puts the process, let's go back to start and start all over with a different lens. And that can make the deal fall apart a little bit in your mind. It makes it harder.
Mm-hmm.
So that's why I just think having somebody to talk through this with and know what the pitfalls are, let's not go there. Here's what happens. If we go that route, this is the path that it looks like. I mean, being able to brainstorm and really think about those things is in the client's best interest, if you ask me.
We think so too. And, again, I always tell the client, the devil's in the details.
Absolutely.
That innocent action of providing the bank statements, because the bank wants to get a sense of where the down payment is going to come from, right? Okay, so let's talk about that. Basically, when you borrow money, the bank's going to have to verify where is the down payment coming from. And, clients get the list of required documents needed, and it says 2 months worth of bank statements. And then they provide all of it.
Right.
For bank statements for accounts you're not even going to use.
Right.
Kids retire, just stuff, right?
Yeah.
Well,
we like to comply. We like to be rule followers.
Yes, I love the Boy Scout analogy. Everybody's a Boy Scout, right? But what you don't know is that a bank is going to go through those bank statements and say, well, what's that?
Right.
What's that?
What'd you do these last 2 months?
Yeah. Why is that reoccurring? And you have to start explaining those things, and the level of frustration starts to go up, and the level of anxiety starts to go up. And then you have a process where you've entered into a contract that's got to close in 30 days.
Right.
And and that's when the train wreck occurs and you get the panic call, right? Whereas when we can sit down with them and say, look, these things are important, but we don't need to provide them that.
Right.
This whole idea of providing a full asset profile, I get it. But you don't need to provide all those if we're not going to use them. Before automation, before, all the compliance and regulation, you could come in with your big box.
Right.
And I would sort through it. We would go through the big box and I go, yeah, I don't need that. I don't need this. I don't need this. Today, in the world we live in, you don't really have that option, because when you apply for financing, most of these banks have pushed you into an automated system. No one's sitting there asking you, what's your first name? What's your nickname? What's your last name? Because all these name variations of yours, Liz, Elizabeth, they're all going to show up on your credit report. And we're going to ask you to address who are these people.
Right.
In the old days, I asked you those questions, so I knew the answers. So now somebody sends you a link and you apply online. It's so convenient.
Right.
And then the convenience is, and if you enter your passwords to your bank account at so-and-so and so-and-so, we'll pull the bank accounts for you and we'll pull your tax returns. And then it all goes up into this big cloud for the bank, right? Well, guess what? It's now there.
Right.
It's part of a permanent record.
Right. Yeah. I don't like to give I like to submit it myself. I will upload to the file and make sure it's what I want them to have for the purposes they need it.
Well, and even that, Liz, it's
still there.
It's still there. And I always tell my clients, look, you can do that. This is your loan. You can do that. However, I want to look at that information. Let's go through it, because if it's going to raise an issue, why do we want to do that? And I'll give you an example. I had a woman whose husband had passed, and it was a very, very difficult emotional time for her. She was selling her house, buying a new one.
Yeah.
And the banker asked for copies of her bank statements, and she had several bank accounts with a specific bank here in town, Frost Bank. And so she starts putting it all together and sends it to me, and she says, I'll just upload it. And so I remember looking at it, and I called her and I said, I don't know that we want to give them this bank statement. And I'll tell you why. Because in here is a big check from your life insurance, from your husband's life insurance. And she starts crying.
Oh, yeah.
And she says, I don't want to deal with that. And I said, well, let me just tell you, Cynthia, when we do, and we don't need it,
Right.
because we have plenty of money in this other account, but they're obligated to look at what's called large deposits. And they're going to want documentation of where that large deposit, and you're going to have to start pulling death certificates out and things of that nature that you don't want to do. So let's just not provide that. It's not relevant.
Mm-hmm.
This is what they need. And the banker really appreciates that, because they don't want to get it and create this whole
Right.
adversity, right?
Right. But they have to follow the process.
They have to follow the process.
Yeah. What about self-employed people, retired people? I mean, how do you go about borrowing for those clients when income may be sporadic, or maybe they're living off of their invested assets and they get an annual distribution?
Sure.
How do you help with that?
Yeah, that's when it gets really fun, and it can be really frustrating, particularly for, clients in your world, because they get upset, they get frustrated, and they say, I'm just going to pay cash.
Right.
Liquidate everything. Sell everything. We're going to buy it. But, it's important for those clients to really understand the power, if you will, of their borrowing ability. An example of that is someone who has a large portfolio and it's invested. And the idea that they can put themselves on a periodic withdrawal, as a matter of fact, they can go every month and withdraw X number of dollars. Well, a bank won't be able to use that as income because there's no guarantee of continuance, right? So, and that's a term for an underwriter. But if you find a bank that can use asset dissipation, which is a term for borrowing and providing income or proving income, you can take the base of that asset or that portfolio, and depending on the bank, you can use a formula to create an income stream that's really what I call a phantom income stream. Mm-hmm. It doesn't exist. You're not going to see it coming out every month. But we know that if you took this portfolio and you use this formula that the bank uses, and the formulas can change from bank to bank, that you can create an income stream that allows the customer to provide ability to repay. And ATR, there you go. And again, like, the client gets really frustrated because, as an example, we had one of your clients who was very frustrated because he was on a disability insurance policy that paid him a lot of money monthly forever. Mm-hmm. However, forever
is limited to your lifetime.
Right. And so subsequently,
right,
we can't prove, continuance.
Right.
So, and he's like, but I get the check. I go, I know, but if you look at the tax return, it's not even showing up on your tax return as income.
Wow.
Because it's not.
Right.
It's an insurance premium.
Right.
So, he was very frustrated, but we were able to demonstrate to him how he could use the value of the portfolio, combined portfolios between his wife's trust and his, and document to a bank that, look, there's enough value in this portfolio that it can provide a stream of income. Mm-hmm. Sometimes, particularly, retired, you mentioned retired folks, they accumulate a large retirement account. You can actually set up distributions and take a distribution and prove to a bank, I can take this much as long as it doesn't exhaust the value of that retirement account. And that can change from bank to bank. Qualify, close, and then
stop the distributions.
Yeah. A banker cannot tell you to do that.
Right.
That would be steering.
Right.
But a consultant like ourselves can advise and say to the client, like, look, you probably ought to do this because this is going to be less painful for you than trying to go a different route.
Right. That's what I appreciate so much about what you do, is just saying, okay, these are the facts. What's the best path to take? If they're all going to get you, from your trailhead to the lake, what's going to be the easiest path for you to take.
Yeah.
And that's the goal, to make it, as least disruptive to the client as possible and as pleasant of an experience as possible.
Well, and the other thing too is like, we don't try to move you from your favorite banker.
Right.
If you go to church with your favorite banker and you love your favorite banker, that's great. But let us get involved. Let us be that referee, if you will, between the banker. And I can tell you, banks love us because I speak their language. One of my clients recently called me the bank whisperer, right? Like, I speak their language. And this isn't unique to me. It's unique to people that have done it for 40 years. And again, I'm not the smartest guy in the world, but if you make enough mistakes,
you learn.
You learn, like, we are not doing that again. Yeah. We are not providing that bank statement anymore.
Right.
I think, customers that retire, as an example, they want to help their kids. They don't know how to help. They want to co-borrow. That doesn't really mean like co-signing. It just gets a little messy. And when you can sit down with the client and say, like, this is what you're really trying to do.
Right.
And when you tell the bank that you only need a bridge loan, do you really know what a bridge loan is? Because the bank knows what a bridge loan is.
They have a definition that fits.
They have a definition. And
does it match yours?
It does not match yours. Exactly.
Yeah.
But again, I would say that although we do provide sort of that filter with the bank and we provide that interface with the bank, we do a lot of work in the education box.
Yes.
Because again, as I alluded early, the more educated the customer is, the better he is at making the right decision for him and his family.
Right. If they know what the consequences are of decisions, then they can decide which path they want to go down.
Absolutely. I've had clients say, I don't want to borrow that much money. I mean, once I sell my house, I'll be able to pay it off. And then and it's like, all right. So what we really are saying is that you want some flexibility to be able to manage the monthly payment once your house sells. So if you thought that you had to refinance this debt and go through this costly experience of refinancing, what we really need is we need a lender that does a recasting product that allows you to make a down payment, pull the loan out of the portfolio, recast the payment based on the rate. We're not refinancing for $250.
I've never even heard of that before.
Yeah. And a lot of clients don't, and they don't know how to ask for it, and they don't know how to prep themselves. So then they call you and say, hey, I need to borrow more money, or I need to pull money out so I can pay off the mortgage because I got, blah, 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 blah. But again, the education piece to me is huge.
Right.
I think, to me, one of the most rewarding things about what we do is when we deal with really, really smart people.
Right.
Well-educated, good at what they do. Successful, but when we can help them through a transaction and they sit there and they say, man, we couldn't have done this without you, that to me is huge.
Yeah, really rewarding. Well, I think of all of these industries, they take specific experience. And like you said, you have 40 years of specific experience. And so when you take somebody from a different industry and put them in this industry, that knowledge that they have built does not transfer to this industry. So True. It would be like self-help for us in a hospital, do I want this drug or this drug for my issue? Do I want this test or this test? We don't know. It's not our industry or piece of knowledge that we have. So going to somebody who is that expert, all of a sudden, there are the definitions to all of these. So now we know more about what we're talking about and can make better decisions.
I think, that's a great segue into something that I think we need to be talking a little bit more about. So you talked about the drug, right? Do I want this drug? Do I want this drug? So many years ago, a very large pharmaceutical company took a specific decision, made a specific decision that they wanted to change how a consumer was going to have access to their drug. And this was a non-sedating allergy medicine. I know it well because I have history in it. So anyway, the traditional way was very similar to what we do today. We went and sat down with our doctor and said, this is what's going on. This is what's happening. What do I do, right? And the doctor would recommend certain things. But this company decided that wasn't going to work for them. That was just not going to work for them. So they took out big ads, big ads, and they put the product, and right below it they said, "Ask your doctor."
Yes.
It changed the game forevermore. And I think the borrowing world is ready for something like that. Instead of you walking into your banker and saying, "What do I do? This is what I need. I don't know." You need to be able to walk into the bank and say, "This is what I want. And this is what I want it to look like. And I know I can pull this off," right? And for me, if I can empower that client to know that,
right,
I think we can change the game forevermore. There was a seminar I went to, and this fellow was talking about sailing, and I thought, where is he going with this story, right? And he was talking about how he didn't know how to sail, but he got on the sailing experience with some folks, and that he was looking at how they pulled the mast to adapt to where they wanted to go because the winds were blowing a certain way. And that one of the guys on the boat told him, he goes, "You don't watch for the sail to get kicked around. What you do is you look at these little strings that are tied to these masts, right? And you notice where the wind is blowing." To me, when I started LSA in 2019, I had that experience. I looked at where are these winds blowing, and I thought, man, the consumer is going to not have a fun time.
Right.
And somebody's got to get out there and help the consumer advocate for themselves.
Well, and that's when rates were nothing. So now that they have a much higher starting point, how has that impacted things?
Well, if you look at rates over history from like 1973 to, let's say, now, we've seen rates hit a high of 16%. Mm-hmm. So
that was the 80s.
Yeah. And then we saw rates in 2021 hit below 3%. Unrealistic, probably, in both examples. Extremes.
They're realistic because they both happen.
Yeah, they did happen. That's true.
They're not normal.
But, it's kind of like, hitting the refresh button every time and expecting something else to happen. Like, people keep thinking like rates are going to come down again.
Right.
They're more than likely, and they're already, you've seen it just last week with the Fed's intent or sentiment, right? Because the sentiment is what drives the market. It's not the actual move of the rate. But the sentiment is that rates, especially on the mortgage side, will start to come down, and folks will be more inspired to get into the marketplace. And quite frankly, rates sitting right now at 6.5% off their high of 8% in October, November of last year. That's a pretty big spread. So it makes buying and using a mortgage product more, people are more inclined to do it. I personally, my crystal ball says that we're never going to see rates at 3% again. God, I hope not. But I do believe that we'll probably settle in somewhere around 5.5 or so for some time. And that's really healthy. The other
it's a great rate.
It's a great rate.
I mean, we have been in a non-normalized business environment for 20 years. Yeah. And for some people, that's their entire career.
Yeah.
So understanding that is really helpful, because if somebody's only been in that environment, they don't know how to navigate a normal environment.
Correct.
But money market should pay you a healthy percentage. It should cost you money to borrow money.
Sure.
And so, that's how businesses thrive, and that's how businesses fail, is when there are consequences to money, whether it's, borrowing it or earning it. And so we are now probably in a healthier environment. However, let's talk residential mortgages. You've got 60% of the country in mortgages that are below 4%.
Yep.
They don't want to budge. So we have this 40% that's available. If they decide to move, it wouldn't be as painful for them to move. So we've taken more than half of the inventory out of the market, right, if they don't want to move.
Well, and I think you can't have a conversation about borrowing, particularly in the residential side, without really talking about what's happened with inventory levels.
Right.
We are probably in one of the most unhealthiest, and I mean that kind of in a positive way, unhealthiest inventory levels in our history. When the market crashed back in 2008, 2009, we had these huge drops in valuation because a lot of loans were made without that ability to repay piece, right?
ATR.
But the challenge that we face, and I always believe all real estate is local. So you really need to worry about what's going on in your market, right? What's going on in San Antonio, Texas, in Austin. COVID has been a big disruptor for inventory because folks found out that they didn't have to drive to the office to go work,
Right.
that they could actually work remotely, right? And some employers, a lot of employers actually said you can work wherever if you want to, right? And there was a huge migration shift. There was a lot of folks that decided, I don't have to live in California. I don't have to live in New York. I can live in Texas. And so when you look at the growth that's occurred, even in San Antonio, Texas in particular, it's huge.
Mm-hmm.
And it's put a tremendous demand on inventory. So now you have these folks that bought houses at 3%, and they're not going to give those rates.
Right.
Like, we're not moving. I don't care if we don't fit in this house anymore.
And if you came from California to Texas, you've never bought more house for less money in your
God.
life.
Those guys came and said, like, put 2 of them in the bag.
Right.
We'll take 2 of those, right? But the truth of the matter is that we really have what I believe a pretty unhealthy inventory level. So what does that do? It means that it keeps prices elevated. We're not seeing drops in value. Now, we don't see the valuation increases that we saw before, but quite honestly, Liz, in Austin, Texas, one year there was like a 14 or 15% appreciation year over year. I mean, that's unsustainable.
I have a client who is in real estate in Austin, and she told me at one point in time there was one house that had 94 offers on it. Mm-hmm. At what point do you decide that being the 87th offer is a wise idea? I mean, why go through the pain of writing?
Yeah.
It was insane on fire. Obviously, we've seen a lot of that slow down and cool off. Yep. And the high highs always have lower lows than other parts because they just grew by such extremes. It's the steady growth that you really want. The less volatility in that market is good for homeowners and home buyers. It can be painful when you're buying at the top, but if you're getting the property you want that serves your family at a payment that you can afford, then, that's kind of the winning combination. I don't think people really considered their house a appreciating asset until probably our generation of being kids is when people started really looking at that. What you were trying to do was buy a home that you could stay the same on, you didn't lose value on, but you were able to raise your family and create memories there and turn the asset back over.
Well, I mean, my parents, probably your parents, they literally bought houses they intended to live in for 20 to 30 years, right?
At $32,000.
And then with, the mobility in employment, things changed.
Yep.
And so people move more often. And, even though you can get a 30-year fixed rate mortgage, the reality of it is that when people say, well, what drives a 30-year fixed rate mortgage? It's really a 10-year treasury that drives that, So it means that these yields, these mortgages have kind of a life expectancy of 5 to 7 years. Most people are going to change their circumstances, go buy a bigger house, scale down, or what have you. But I'll tell you that our inventory levels are not getting any better, and the only real way to change inventory significantly is through new construction. Mm-hmm. Home builders can provide 1,500 units in a year,
right?
15,000 units in a year. Well, guess what's happened, which we didn't get into, and hopefully we can do some other session on commercial lending. Well, builders aren't borrowing to go build because rates are high. Mm-hmm. So it's put this damper on actual delivery of inventory. So it's kind of stuck. Mm-hmm. People don't want to sell their houses. A healthy level of supply and inventory is roughly 6 months. Okay. That's always been kind of the measure. If you have more than 6 months supply of inventory, then it's usually a buyer's market. Like, hey, we've got choices.
Yeah, we haven't seen a buyer's market in a while.
I mean, at the height of 2021, 2022, we were down to less than a month's supply of inventory.
Wow.
So subsequently, if it came on the market, you had people all over it, right? And then you saw this subculture of off-market real estate where people would whisper like, we've got something coming up and it's going to be priced at this, and people didn't want to compete with everybody. So they'd go after these pocket listings, right? But the truth is that I do believe that, at least in San Antonio, when you see all the great things that are going on in the city, people are going to continue to want to move here. In fact, a lot of the migration we have is from Austin. People want to move
Absolutely.
from Austin. And,
well, it got too expensive. The traffic is horrendous. There's all kinds of things you can go down, but we look a lot more attractive than that market for buyers.
Absolutely. And I think we've got this cool hip vibe,
Yes.
And people like it here. I think it's a much more walkable city as well. But the point is that I think in San Antonio, values will continue to stay, there's no crisis.
Right.
It's just, you got to pace yourself and you got to come to terms with the new reality that rates are not going to be 2.5%, that they're going to be in the 5.5%. And that's as you said, that's a great rate. And these homes were never, to your point, to be investment vehicles, but they did. They did when they started appreciating at 14, 15%.
Right.
They go, oh my God, let's sell it. How do you move?
Yeah, then where are you going?
I don't know.
The problem is the next house appreciated that much as well.
Exactly. Yeah.
So when I have clients that have borrowing needs, what should I be asking them?
Are you prepared to borrow? Do you know what that world looks like?
For the process that you have to go through.
Are you? When was the last time you borrowed?
Great question.
When was the last time you borrowed? What did that feel like? Let's talk about that. Let's talk about what those needs really are and how do we get there.
What are you trying to achieve? What's the purpose of it? And then we can talk about what options you have.
Yeah, absolutely. And I think, my wish for you and others in your industry is that when it comes to borrowing, that the client understands you're the resource to go to, not necessarily the bank first. Because so much of what happens in the wealth world is focused on one side of the balance sheet, the asset side. But I can tell you, one wrong borrowing move on the other side of that balance sheet can really throw that whole planning thing off, right?
Puts assets at risk.
Yep, it does.
Do you have any tips or thoughts you want to leave people with? Best practices. You've woven them throughout the conversation, but
I mean, I would say approach this with a healthy attitude. Borrowing should not be fearful. You should not be anxious. And the best way to overcome those feelings is to become educated.
It's a great response.
Yeah. Well, I think so.
Well, it like we said at the beginning, it demystifies things. If I know what I'm doing, if I know what the protocol is, then I can anticipate what's coming, and then I can feel more confident in what I'm doing.
And the only other piece is, don't assume you're going to get that from your banker, because they're limited to what they can tell you and what they can't tell you. And today, as an example, in some banks today, the bank has removed the print function from his dashboard.
Yeah.
I could print things for you if you came in to see me, but now even if I wanted to help you and say, like, I can't tell you, but if you see what's on the table there, you might want to read that. I can't even print it.
Interesting.
And they know when your cell phones are on and they're recording your conversations and all that stuff.
Well, I know we've seen keystrokes being recorded by firms in our industry and telephone conversations and all of that. So there is nothing private anymore in many ways.
Yeah. Just, and I will say, as it's well-intentioned.
Right.
It's well-intentioned. I get it. The problem is that when you would hear a bank say the customer comes first, the reality of it is that they come first because they're trying to protect their liability side. And if you give them some offhand advice that's good advice, and for some reason it doesn't turn out well for that client,
Right.
the banks worry, and rightly so, right? So they say, you can't say that, you can't say that, you can't say that, you can't tell them that. So it becomes very frustrating. But again, don't assume that your banker is going to be the source of that strategy. You're going to have to look elsewhere.
Just because he's boxed in.
They're very frustrated.
Yep.
My banker buddies, my banker friends, they're very, very frustrated right now. And it's just going to get worse.
Yeah. And I think that's one thing I want to hit on. I don't think of you as limited in who you can go to, because you do have all these contacts throughout the industry. And so when you have a client with a specific need, you can match that with a resource that can meet that need on the other side of the table.
100%. And one of the biggest challenges right now the bankers have is that you call your banker and you say, hey, we're buying a house in Aspen. And the banker says, we don't lend there.
Right.
Well, what do you mean? Well, we don't lend there. Just that simple, right?
Right. That's the box. They can't get out of it.
Yeah. Or, hey, I need a loan. I just built a house and I'm self-employed. And the banker says, we don't underwrite self-employeds directly. We actually have to send them to the investor. These kinds of things, right? So when you have, access to, services like ours, we don't have any limit. I'm not tied to a bank.
Right.
I'm really looking for, where does your need unfold with the least amount of trouble, right? For lack of a better word. And best if we can create a great experience for you.
Right. Reduce friction, solve the problem in the cleanest way. I
tell clients, look, I don't have any power of attorney. We don't want any of that. We don't sign anything for you. We're here as your advocate.
Yeah.
Let us collect the documentation. Let's look at it. Let's talk about it before we send it somewhere. Let's be measured in what we tell the bank and how they want it, right? But we become that interface. And I tell banks that understand us, like I said, they love what we do. Because they can call me and say, like, I don't want to ask this question, but we're going to need to get into this. And usually I already know the answer to it, right? But I tell the banker, like, you're not to ask my client for anything without coming to me first, us. And I want it to be transparent. So I want you to copy the client so he sees it. I don't want my client calling me because he has to stop his golf game, because he has to go dig through his underwear drawer to go find that piece of paper you need. When I look at the request and I go, you don't need this. Mm-hmm. Well, we really do. No, you don't. I know you don't. Get it waived.
Right.
And when we can waive it, we can show them why they don't need it. Sometimes they don't know because the underwriter says, I want it.
Yep. No, exactly. It's the way it works.
And it's like, well, want and need are two different things.
Yes. That's another show.
Yes, it is. Yes, it is.
So, Joe, I ask everybody, since our podcast is This is Wealth, and we're about living life richly. I consider what you do helping live life richly.
Thank you.
What does wealth mean to you?
To me, wealth means freedom. It means freedom to go about and enhancing the quality of your life. And it's different for everybody, Liz. I've worked with clients that have a lot of wealth and are unhappy. And I've worked with clients that don't have much wealth and are happy. I tell my kids this, and I tell my clients this, like right now, particularly with social media, comparison is the death of happiness.
Yeah.
Don't do it. Don't do it. Figure out what makes you happy. Build your life around that and be rich.
I didn't look at social media once yesterday, and my day was not impacted by it.
Well, you missed the part.
I have found that it is a little bit richer without I don't know. I think it just drags you down and takes you down a couple rabbit holes you don't need to go down. You look up, it's an hour later.
Oh, yeah. Well, remember you and I probably grew up when we had 3 TV stations.
Absolutely. And you had to get up and change it.
You had to get up and turn it on.
That's right.
It wasn't screaming at you like, hey, did you see this just happened? Or like my CNBC feed and things like that.
Well, and it stopped programming.
Mm-hmm.
You had to go to bed.
You had to go to bed.
Yeah.
It would just go like, shh.
Right. Poltergeist.
And I think the last thing it said is like, it's 10 o'clock. Do you know where your children are?
Yeah. No. Thank you very much for the conversation.
You're quite welcome. This was fun. I appreciate it.
Thank you.